This week in the AI chip race, the focus is shifting. While one company has dominated the headlines, another is quietly architecting the custom silicon that powers the world's biggest tech giants. Despite a wave of bullish analyst ratings and news of massive AI contracts, Broadcom's stock has faced headwinds recently. So what's behind this disconnect between market sentiment and the company's booming AI business? Welcome to TickerWatch News for Broadcom, Week 5, 2026. In this episode, we'll cover the latest news and developments for Broadcom, a company at the center of the artificial intelligence infrastructure buildout. Stock Snapshot. Broadcom's stock experienced some weakness over the past month, closing around $331 per share at the beginning of the week. This move underperformed the broader S&P 500 and the Electronics-Semiconductors industry, which saw gains over the same period. This recent dip comes despite the stock having climbed roughly 55% over the last year, reflecting a complex picture for investors weighing near-term trends against long-term growth. Top news and headlines. The biggest story for Broadcom continues to be its expanding role in the artificial intelligence sector. A recent report from Counterpoint Research projects that Broadcom will hold a dominant 60% market share in the custom AI server chip market by 2027. Unlike general-purpose GPUs, Broadcom specializes in creating custom-designed chips known as ASICs for hyperscale companies like Google, Meta, and Microsoft. These tech giants are increasingly designing their own silicon tailored to specific AI workloads for greater efficiency and cost savings. For example, analysis from Goldman Sachs noted that the custom Tensor Processing Unit, or TPU, developed by Google and Broadcom, is estimated to reduce the cost per token by a staggering 70% in its latest version. This strong position in the AI space has led to a flurry of positive attention from Wall Street. In the past week, Wolfe Research upgraded Broadcom to outperform with a $400 price target, citing growing confidence in Google's TPU program. Bank of America reiterated its buy rating with a $500 target, and Wells Fargo upgraded the stock to overweight, boosting its price target to $430. Analysts pointed to the company's multi-billion-dollar AI backlog and its essential role in networking technology as key drivers. In legal news, Broadcom and Fidelity Investments resolved a dispute from last November. Fidelity had filed a lawsuit accusing Broadcom of threatening to cut off access to what it called business-critical software after Broadcom's acquisition of VMware. The companies reached an agreement, and Fidelity confirmed their services will continue without interruption. And looking ahead, Broadcom announced it will report its first quarter fiscal year 2026 financial results after the market closes on Wednesday, March 4th. The company's management will host a conference call that day to discuss the results and its business outlook. Market reaction and investor sentiment. Investor sentiment around Broadcom appears mixed, creating a disconnect between the stock's recent performance and overwhelmingly positive analyst commentary. The stock has trended down over the past 30 days, even as a majority of analysts have issued bullish forecasts. Out of 42 analysts covering the stock, 36 now rated a strong buy. Price targets were increased by several firms, including Wells Fargo, Wolfe Research, and Mizuho, with some targets suggesting a potential upside of over 30%. Citi maintained a buy rating with a $480 target, citing accelerating AI sales. However, not all analysts are in agreement. RBC Capital initiated coverage with a sector perform rating, pointing to the stock's premium valuation compared to peers as a reason for a more cautious stance. In a notable institutional move, it was reported that Cathie Wood's ARK Invest purchased over 143,000 shares of Broadcom during a recent dip, a transaction valued at over $50 million. This signals strong conviction from at least one major investment manager, despite the stock's recent volatility. Fundamental check-in. From a fundamental perspective, Broadcom's story is one of a premium valuation backed by powerful growth drivers. The company's price-to-earnings ratio stands at about 68, significantly higher than the semiconductor industry average of around 42. This premium reflects high expectations for its role in the AI buildout. Some reports flag the stock as trading above its estimated fair value. The bull case is centered on the company's AI revenue, which now accounts for over half of its semiconductor sales. Broadcom expects AI revenue to double year-over-year in the first quarter of fiscal year 2026. The company's deep-rooted relationships with hyperscalers for custom chips and networking solutions provide a strong, visible pipeline of future business. On the other side of the ledger, risks include the company's high debt level and the challenges of integrating VMware, which has led to some reports of customer churn. The business is also highly concentrated with a small number of very large AI customers, meaning any shift in their spending plans could have a significant impact on the business. What to watch next week? The most significant upcoming catalyst for Broadcom is its first quarter earnings report, scheduled for Wednesday, March 4th. This will be the first major update on the company's AI revenue and VMware integration progress in the new fiscal year. A bull case scenario would see AI-related revenue exceeding the company's already high expectations, coupled with positive updates on the VMware business and a strong outlook for the rest of the year. A bear case would involve any sign of slowing demand from its major AI customers or indications that the VMware integration is facing more significant headwinds than previously understood. Geopolitical risks remain an overhang for the entire semiconductor industry. The base case is for Broadcom to report another strong quarter, driven by its AI business, but investors will be closely watching for any changes to its growth trajectory and how the company is managing its high valuation and debt load.